What if you could predict a recession before economists, before the news, and sometimes even before governments admit it's coming? There's actually one economic signal so accurate that it has predicted every US recession for the past 50 years. And here's the wild part, it's public, it's simple. Anyone can check it, yet almost nobody does. Today, I'm showing you the indicator governments, banks, and hedge funds watch like a hawk, because when it flips, the economy usually follows. Most people think recessions happen suddenly, like a crash, like a surprise. But real economic downturns almost never come out of nowhere. They leave clues, quiet ones, hidden ones, signals buried inside financial systems most people never look at. And among all of them, unemployment, inflation, GDP, stock markets, one stands above the rest in predictive power. It's called the yield curve, and once you understand it, you'll start seeing recession warnings months, sometimes years, before they hit. Okay, quick breakdown. Governments borrow money by issuing bonds. Those bonds have different time lengths. 3 months, 2 years, 10 years, 30 years. Normally, the longer you lend money, the higher interest you expect, right? So long-term bonds usually pay more than short-term ones. That creates a normal yield curve that slopes upward. Short-term equals lower rates. Long-term equals higher rates. Makes sense. But sometimes something strange happens. The curve flips. Short-term rates become higher than long-term rates. This is called an inverted yield curve. And historically, that's when alarms start ringing, because this weird little flip has predicted every major recession in modern history. Before, the 2008 financial crisis, the 2001 dot-com crash, the early 1990s recession, the early 1980s recession. The yield curve inverted every single time, not once, not twice, every time. It doesn't predict when the recession starts exactly. But historically, when the curve inverts, a recession usually follows within about 6 to 18 months. That's why Wall Street watches it obsessively, because it's not based on opinions. It's based on trillions of dollars of investor decisions. It's the market collectively whispering, something's wrong. So why does this happen? Why would long-term interest rates ever drop below short-term ones? It comes down to expectations. When investors believe the economy will slow down in the future, they rush to buy long-term bonds to lock in current rates before central banks cut them. That demand pushes long-term yields down. At the same time, short-term rates stay high because central banks often raise them to fight inflation. So the curve flips. In other words, an inverted yield curve is basically the bond market predicting slower growth, lower inflation, future rate cuts, economic stress. It's not magic. It's collective forecasting by millions of investors risking real money. And money tends to be brutally honest. Here's the strange part. Despite its track record, most people don't pay attention to it. Why? Because it's not dramatic, it's not breaking news. It's just a line on a chart. Humans are wired to react to loud signals. Market crashes, layoffs, bank failures. But by the time those happen, it's already too late. The yield curve is quiet, subtle, boring, and that's exactly why it's powerful. Because by the time headlines scream recession, the smart money has already moved. But here's where things get controversial. Some economists think the signal might be losing its power. Critics argue modern central banks interfere too much in markets. They buy bonds. They manipulate rates. They inject liquidity. So maybe the yield curve is distorted now? But here's the counter-argument. Even in recent decades of heavy intervention, the indicator still hasn't been wrong, which creates a strange situation. Everyone knows about the signal. Everyone watches it, and yet it keeps working. Almost like a fire alarm everyone hears but hopes is malfunctioning. So here's the takeaway. Recessions don't appear out of nowhere. They send signals first. And the yield curve is one of the clearest signals we've ever found. It's not perfect. It's not magic. It's not exact timing. But historically, when it flips, something big tends to follow, which means the real question isn't, will there be another recession? Because there always is. The real question is, will you see it coming before everyone else does? In the next video, I'm breaking down something even more powerful than prediction indicators. The economic metric governments quietly change the formula for... So the numbers look better than they really are. And yes, it's completely legal. Subscribe if you want to see it before it disappears from your feed.